Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video I want to talk about building a diversified options portfolio. So there's no doubt that diversification on any level helps reduce risk, but it also helps reduce profit potential to some degree, just to be fair. In fact, a famous Buffett quote he once said was, "Diversification is a protection against ignorance. It makes very little sense to those who know what they are doing." So since we really don't diversify on our strategy, meaning we are net option sellers and we do that, that is a targeted strategy for obvious reasons because we know we have an edge there. We need to then reduce risk where we are ignorant and do not have a reliable edge. And that's, I think, the difference, hopefully, between a good trader and a bad trader is a good trader might know exactly where his edge is and focus all of his attention there and then help reduce risk in places where he has no edge, meaning for us, that's really stock picking. So we want to have as much possible diversification as we can in the number and type of underlying securities we're trading options on because, again, we know that our edge is in implied volatility. It's in selling options long term. It is not in picking the direction of a stock. That's why we always try to be as neutral as possible. That's why we're always selling options with high implied volatility. That's why we talk very, very little about the benefits of directionally getting a stock right or wrong. So the reality is that we want to be as uncorrelated as possible, meaning we want to look across all of these different asset classes, industries, sectors, whatever you want to call them, and we want to be as uncorrelated with our trades as possible, meaning we want to have a lot of trades on that don't have any relationship to another. So for example, if you look at this chart here, you can see that anything in the oil sector has very little correlation with anything in consumer staples. Okay, so if we had two trades on, one in the oil sector or an oil ETF and another in consumer staples, they really would move kind of independently of one another, meaning that if consumer staples went up, oil might go up or it might go down a little bit, but it's not really going to be dragged in one direction or another by the other industry. Versus if you look at something like industrials or the industrial sector and consumer discretionary, you can see that there's a high correlation or almost a one-to-one correlation between those two sectors. So if we're making two trades in consumer discretionary and industrials, then they're going to have a high correlation of moving together in the same direction. Does that mean that we can't make a trade there? No, it just means we have to be aware that there's going to be a high correlation between these two. And this is a great little chart to use. It's over from our friends at Bespoke on all these different correlations over the last 10 years from these different industries. Now, the truth is that diversification for us is a never-ending process. It is a goal, it's not a destination. There is no perfectly diversified portfolio, and there never will be an unlimited amount of uncorrelated securities. Even going back to our chart here, you can see there is not one single sector that is totally 100% not correlated with something else. Everything has some sort of small correlation, negative, positive. It might be very small, but everything is correlated with one another. And our goal is just to mix up the number of trades in the sectors and industries that we're trading, the ETFs, the stocks, etc., and the directions, because that's where we don't have our edge. We want to make sure we're selling options across the board as much as possible, but we want to mix up the securities that we're trading on. So again, balance and diversification is always a goal, but a constant moving target, meaning that as soon as the market trades and starts moving, then it's always going to be a moving target. You just have to recognize that. In our opinion, we think beta weighting, as we talked about previously, helps focus our attention on the overall portfolio versus single options. Because beta weighting takes all of these different industries and makes them relevant to one ETF or index that you're focusing on, that you're using for your beta weighting. So now it kind of brings everything together and says, okay, look, if my basket of portfolio, if I have gold and industrials and consumer staples and financials or whatever the case is, what does that look like kind of brought together if it was one big S&P 500 position or one big DIA Dow Jones position or whatever the case is. So that's why we like to use portfolio beta weighting, because it helps kind of focus and hone in our attention on what we should be doing. So common questions I wanted to go through real quick. First is, everyone always asks, what if I can't find good trades in different industries, sectors, or asset classes? Now, the reality is that sometimes industries will fall into and out of favor, meaning that at certain times during the year, maybe oil and metal stocks might have high implied volatility, and therefore those are the best trading vehicles. Then later on, it'll be financials. And then later on, it'll be utilities or whatever the case is, or technology. Okay, so not everything will have great implied volatility all year so that you can evenly trade all of these different asset classes. So our response to this question is that you have to still target whatever has the highest implied volatility. And if, let's say, that sector right now is financials, and only the financial sector has high implied volatility, then what you want to do is you want to diversify within financials as much as possible, okay? Because you still have to trade short premium. That's still our edge. That's where we need to focus our attention. But within financials, maybe you trade JP Morgan bullish and you trade Bank of America bearish, okay? So you try to diversify the stock that you're trading, JP Morgan to Bank of America, and you try to diversify the strategy. You trade one a little bullish, you trade one a little bearish, you're still selling options net, you still have a wide area for margin for error for trades, so you just have to work with whatever you get. When implied volatility is really high across the board, which doesn't happen all too often every year where we get, kind of the broad market to have really high implied volatility, then you get your pick of the litter. Then you can really, choose to diversify whatever you want to do. But when you can't find trades in different areas, you got to go a little bit deeper and try to do it on a one-to-one basis. Next question is, do you prefer ETFs over stocks? And the answer to this is generally yes. So given the choice, meaning that if I was looking at an ETF which had implied volatility in the 90th rank, and I was looking at a stock which had implied volatility in the 90th rank, I would choose the ETF over the stock given all else being equal. And the reason is because stocks obviously have a little bit of additional risk that they could get bought out or could announce a bankruptcy or a merger or whatever the case is. Generally, you're not going to get that type of huge one-day, unsystematic risk movement in a stock. So all else being equal, I will choose the ETF. Does that mean I prefer those over stocks? Not necessarily. I really prefer whatever has the highest implied volatility. So if 10 ETFs have implied volatility at the 60th rank and 10 stocks have implied volatility at the 90th rank, I'll choose the 10 stocks first, try to make trades in those before I work my way to the ETFs. Okay, so that's always the choice. Next question is, should we diversify across different option strategies and timelines? And the answer to this question is without a doubt, yes. In fact, if you think about it, when you are trading, our goal here is to create a consistent reoccurring stream of income. If you only traded 1 month and didn't worry about kind of planting seeds or making trades for the next month coming up, then you really don't have any foresight or kind of, projection of where you think your income is going to be. So I definitely agree on the notion of really focusing in and honing in on the most profitable strategies. Those are the short premium strategies, straddle, strangles, iron condors, credit spreads, etc. But maybe having a good mix of some of the other ones, just a couple to make some small bets in case, implied volatility continues to go higher or whatever the case is, and then also diversify out over time. So this is actually a look at my portfolio right now as we're kind of, just recording this video just to give you an idea. But you can see now that, we've got iron condors, we've got a bunch of straddles and strangles because that's generally where we make most of our money. And you can see the iron condor and the straddle and strangle, we're making most of our money right now on these 2 short premium trades or strategies versus what we are losing on the 2 other long volatility strategies, which is our calendars and call debit spreads. So it's not that we need to, not trade these. We can trade these on a very small scale. Okay, $100 of potential loss here, maybe before they get closed out. Maybe $20 here for a calendar. But we've got a little bit of diversification. So if implied volatility does go up, some of these strategies are going to win, and they'll help kind of buffer some of the profits and potential losses that we might have on short premium. Still, short premium strategies are the bulk of what we're making right now. I mean, this is where we're making our money on short premium strategies that we're trading. It's just that we have diversification. Now, that also means that we've got diversification out over time. So like just one example of this and a quick example is we've got an iron condor and USO. This thing expires in 14 days. We've got this IWM trade. This thing expires 49 days. So it doesn't really matter how you kind of set this up. There's no perfect way to do it, but it's just understanding that you should stagger and stack some of your trades out over time. So have some trades that work in the front contract month, which is right now April. Have some trades that work in the back contract month, which is right now May. You just want to have a little bit of spread in those trades out over time, which will help you out. Last question is, how do I know if I'm correctly diversified? The answer is there is no correct diversification. There's no way to know that you are 100% correctly, perfectly, whatever you want to call it, diversified, because there's no ultimate diversification portfolio. What I say is that you should always just be double checking your portfolio beta weight. So double check your beta weight relative to whatever index you're tracking, because even if you're trading all financials, you can still beta weight it to an index and see if you have any risk or exposure to one side or the other that you might, go out and look for trades that help kind of fill that gap. So again, there's no perfect portfolio. There's no way to tell if you're correctly diversified. It's always a moving target, but I mean, look, you just want to use a little bit of common sense here, trade, a lot of different ETFs if possible in different industries and sectors if possible. The main thing here is that we do want to focus our attention on implied volatility and short selling options. That's where we get our edge. We need to then try to diversify as much as possible in the underlyings that we trade. So as always, hope you guys enjoy these videos. If you have any comments or feedback, I'd love to hear it. Ask them in the comment section right below this video. If you love this video and this talk on diversification for options trading, please help spread the word by sharing this video online. Send it to your friends, your families, your coworkers. Help spread the word about what we're trying to do here at Option Alpha.